we have our proprietary fundamental approach for the construction process. You might have heard of us, or Jeff referred to this as the Gestalt, where instead of just, again, letting the computer optimize and based on the stock alphas telling us how the portfolio, what stocks we should buy and sell, it's a human decision. We're making that based on a lot of data and science as an investment committee, and we're trying to tilt the portfolios to various exposures and themes to kind of capture a little bit more of that enhanced return relative to the market index. Turning to page 7, so the prime strategy that the city is using in the portfolio, again, this is an enhanced index strategy. It's going to look, feel, kind of smell, and perhaps taste like the market. We're not trying to swing for the fences and maybe hit the home run a couple times, maybe 1 out of 10, like the Pittsburgh Pirates might. Instead, we're trying to consistently hit singles and doubles, and outperform a little bit over time, and that little bit over time will really compound into enhanced alpha for the city. So turning to page 8, and a brief review of the returns. So recall from the initial inflow into the prime strategy in 2018 of $33 million, and then there was the additional investment across at the end of 2020 and 2021 for the pension obligation bond. Even netting out outflows that have been used for benefit payments or other expenses over time, effectively that net inflow of $43 million, as you can see on the page at the end of October, was worth $87 million. And actually, to give you a little bit of a flash update, through Tuesday, through November 12th, it was actually worth $91.7 million. So, we'll talk about the time weighted returns, but just to pause and step back, in terms of dollar growth over that roughly 6 and 3-year period, the initial inflows to the prime strategy has more than doubled. Speaking of the annualized return, it has generated since inception a 13.1% annualized return that is both gross and net because of the incentive performance fee that we have not yet collected, largely in line with the market over that time of close to 14%. And we'll talk about the markets in a minute, but I do just want to take a step back and pause that for over a 6-year period, let's say the large cap equity markets have returned over 13%. Really just to take a step back and, if we could lock in and get that 13% annualized return for the next 3 decades on an annualized basis, that would be, something I think we'd all sign up for. But really, it's been a phenomenal time in the equity markets, and particularly as we turn to page 9, I know this is something that we've reviewed before, but just looking back, the timing of that pension obligation bond was really quite effective. For that $20 million that was invested across 2020 and 2021. At least with the prime strategy, it has done quite well. Since that time, the prime portfolio has outperformed the market. The strategy since that time was up 13.3% compared to the market of 12.8. So from an asset allocation perspective, investing those additional funds in 2020 and 2021, you generated a great return. But additionally, at least with the prime strategy, it's also outperformed the market and added some alpha over that time. Transitioning to year-to-date, as we mentioned on the bottom of page 9, what the strategy's done year-to-date through October. I can give you, again, a little bit of a flash through Tuesday, November 12th. Because the market has been so much up in November, but even through October, the strategy was outperforming the market year-to-date, but that's continued, or at least through the November period. Year-to-date, your portfolio is up 26.9%. That compared, it's about 30 basis points higher than the Russell 1000 in the market of 26.6%. So, again, as we can now, from our perspective, if we could lock in that year-to-date return of, for the strategy, nearly 27%, that would be a great year. It comes on the back of 2023, but really a strong overall time for the equity markets. Shifting to page 10, not going to spend a lot of time on this. But obviously providing the trailing returns, for the trailing, and I will point out the year-to-date period that is shown here. That was, I know on the top of the page it shows September. That was referencing the third quarter. The column that shows year-to-date, that's actually through October, like we talked about on the prior page. But just want to make a note here. Since COVID, the year of 2020, when the strategy and most equity managers, active managers struggled, the strategy has really bounced back since then. You can see, based on the trailing 1, 2, 3 and 4-year returns, really, again, since the timing of the pension obligation bond, the strategy has done well and it's outperformed and it's met its objective. Taking a quick look on page 11, in terms of the the strategy, and it's a little bit of an attribution, trying to understand what has done well, what hasn't so far this year. We provided a summary attribution. This is from Barra Aegis. It's one of the tools that we use for portfolio management and attribution. Instead of us just telling you what the returns are and trying to say what we think it's coming from, this is a sophisticated risk model that kind of does that for us. And so I'll highlight line items 4 and 5. This is showing that there was a positive contribution to return from risk indices, which are essentially factors, as well as industries. It was very slight in terms of asset selection, but negative 8 basis points. Not too material, but the point being, and the takeaway here that with the strategy outperforming so far this year, that's come in large part to our fundamental tilt positioning and essentially being exposed to some of the right themes at the right time. The next couple pages are the long run performance of Prime. We've obviously we've worked together for many years. I don't need to spend too much time for it. Maybe the one thing, as I just flipped through, reminds you on page 15 that essentially one feature of the Prime strategy is the consistency of outperformance relative to its benchmark. It's outperformed the large cap market, the U.S. large cap market, about 3/4 of the time on a rolling 3-year basis. But also, beyond that, it has also been an above peer strategy. It's been, when you're looking at potential investments for the city, obviously you want something that's outperforming the market. You also would like something that is better than the opportunity set, better than peers. Shown on page 16 and 17. On page 16, looking at all rolling periods 1, 3, and 5. You can see on the far right that much more often than not, about 3/4 or 80% of the time, Prime is above its the peer averages across 1, 3, and 5 years. And then on page 17, we just show the trailing the peer rankings for trailing returns, and just to point out that it's been for all the periods 1, 3, 5, and 10, it's also been an above peer median strategy. So shifting to page 19 and how the portfolio is currently positioned. Recall, due to the enhanced index nature, we're not going to be taking large bets with respect to various themes of size and style and stability or sectors. But obviously, we are taking a couple basic, a couple percent here and there because we're trying to capture some of the inefficiencies in the market, some areas where we think are perhaps undervalued or will, provide some alpha in the next, short, medium, and long term. So looking at the page, I'll point your attention on the left side. First with respect to size, this is one that we've talked about. It's kind of a key component of our fundamental tilt. And we break up the Russell 1000, the U.S. large mid-cap market, into deciles. And this is, again, one of the ways that when we're doing the rebalancing, and we're meeting as an investment committee, that we're actually looking at the portfolio kind of into these deciles and understanding where our bets are relative to the market. So first, and maybe the largest point, is that you can see for the top 2 deciles, the top 100 and 200 largest names in the Russell 1000 index, we have a net underweight of about 3.1%. On the flip side, we're overweight to the mid-cap stocks in the market by about 3%. And what's not really shown, but I will call out, is something that I know we spoke about last year in the meeting, is how the Prime strategy throughout 2023 was overweight to the Mag 7 stocks. That was a tailwind and one of the reasons that we outperformed in 2023. And as we thought, and we've seen that the concentration is at such an extreme in the U.S. large cap market, we dialed that overweight back a little bit. Now we're effectively neutral to the Mag 7. We're overweight some of those Mag 7 stocks, particularly NVIDIA, that are higher ranked in our model, and kind of balance it out with some of the other Mag 7 stocks. But again, if we have a 3% underweight to the top 200 in total, but we're effectively neutral on the Mag 7, that implies that we're underweight, even to about that same amount to kind of that next call it 193 stocks in the top 200, which is where we want to be. We want to kind of have a barbell approach, if you will. We're kind of neutral right now to the Mag 7. We're underweight those kind of next largest names, but then we have the overweight to the mid cap position, which you can see kind of how that's trended on the next page. But to stay on page 19, I'll just call out, we have a very slight overweight to value right now. It's about 1.9%. That's a little bit less than we've had maybe in years past that have been, maybe around 3-4%. But one of the tilts that has changed this year is that, going back to about a year ago, we were slightly overweight defensive stocks by about 1%. But now at this point, at the end of October, we're actually have a slight overweight to dynamic stocks, and I'll go into a little bit more detail of how that's worked. But part of the reason that we've shifted that in, let's say, the last 6 months is having the expectation that the Fed would be cutting rates. Our expectation was that would be a little bit more beneficial to smaller and mid-cap stocks as the cost of borrowing comes down, and you have a lot of smaller mid-cap sized companies that are have a lot more elasticity to the cost of borrowing. They have a lot more debt, a lot of times more floating rate compared to some of the largest names in the market that are investment grade and have more fixed cost borrowing. So knowing that the Fed would be cutting rates, our expectation was that would benefit the more dynamic stocks relative to defensive. Again, when we're referring to dynamic stocks, this is the Russell Index kind of groups stocks into 1 or 2 categories: defensive or dynamic. Defensive are those companies a little bit more analogous to ones that might pay a dividend or have more stable earnings, more less stock price variability, less earnings variability, compared to the dynamic peers, which do exhibit more, a little bit more cyclical, have more earnings variability, more stock price variability. And again, our expectation with Fed cutting rates that dynamic stocks would benefit a little bit from that. Moving on to the right side of the page, looking at the sector exposures. Again, we keep all the sector exposures very tight. You can see that right now we don't even have any sector exposure that's greater than plus or minus than 50 basis points. Again, we're trying to really capture the alpha through our stock selection and our tilts with respect to some of those themes, not so much from directional sector bets. The beta and the tracking error of the portfolio, both right around 1. We're always trying to keep beta at 1, and tracking error is on the lower end of the range, just as we recognize the market has been so concentrated, and it has been at least in the past, it has been a fairly tougher environment for active managers overall. So we wanted to keep that risk level low, and in the hopes of protecting on the downside and not having any strong and extreme deviations from the market. I'm shifting to page 20 to kind of show you the exposures over time. And to quickly run through it, the bar in dark blue is essentially that mid-cap vote versus the top 200 bet. You can see kind of at least from the end of the second quarter, we've increased that a little bit. We brought down the value bet versus growth, but again, the key point I wanted to mention, especially if you go back about 9 quarters ago, looking at the gray bar, we were about, again, at the end of 2023, we were 2% overweight to defensive stocks, and that's kind of one of the key tilts that we've changed throughout the years is slowly, and because we don't make these changes, we don't go from 2% overweight to defensive to 1% overweight dynamic all in one fell swoop. It comes over the course of multiple monthly rebalances, but that's one of the shifts that we've made so far this year. And as you can see on page 2021, it's actually one that's paid off quite nicely. On page 21, we're looking at the dynamic and defensive index relative to one another on a trailing 12-month basis. The dynamic index is in blue, defensive is in red for the Russell 1000. And you can see that over the trailing 12 months and kind of even going back over the past year, that dynamic stocks have continued to do very well relative to defensive stocks. Year to date through October, the dynamic index is up 24.6% versus defensive stocks, which are only up 16%. Post-election, that's continued in November, where dynamic stocks are beating their defensive peers by about 3%. It's funny, I mean, we have the next call it 20 pages of our all market material here, and generally go through October. It somewhat seems it's not stale necessarily, but especially post-election, what we've seen so far in November, it seems like that's a little bit more of the interesting things to talk about. That being said, there's a couple things that I will touch on that are, I think relevant to understand of what's happened so far this year, and then obviously have some remarks of what's happened so far in November. A couple themes that I want to touch on. One, seasonality. Two, kind of the overall trends on a variety of different dimensions from the first half into the third quarter, and then what we've seen so far in the fourth quarter. Have a page here on sectors. Obviously, another, when we're talking about the equity markets now, concentration is not something that we can avoid. It's obviously been a key driver and something that we've spent a lot of time considering. And then lastly, just talking about directional earnings for the overall market. But looking at page 22, and I'll try to be sensitive to time, so move through pretty quick. But on page 22, this is something that we've shared with clients quite a bit over the years, just to remind them of seasonality of the markets. Coming from academia and our investment committee and being students of the market, we recognize that there's certain, obviously a lot of trends, and there's sometimes seasonality and seasonal patterns with the market. And something that we pointed out to clients, towards the end of summer, pointing out, reminding them that September is usually, which you can see on the page here, and we highlight that has a negative average return for the market. The whole sell in May go away. Traders and maybe some hedge funds and other institutional investors come back to their desks in September after being away for a few months. And usually we see a little bit more volatility, but September is typically a negative month for the market. While that wasn't the case this year, September was positive and October was actually negative. The other key point is that November and December are typically strong months for the market. You can see in terms of the average return, November has always been the best return for the market. And in a lot of cases that has come, well, not every year, but every 4 years we do get an election. Usually the market responds positively following an election. Just in any case, you have some level of uncertainty of who the president will be, which party will control Congress. And as the pattern held so far this year, once we got that clarity, once we had the election, the days subsequent, the market has run up about 6% so far in the month. But again, just noting that the percentage of positive months for November and December are usually quite strong. Turning to page 23, talking about some of those trends that really continued, that began in 2024 in the first half, that were in a lot of cases a continuation from 2023. A lot of those reversed in the third quarter, but then we've actually seen kind of a snapback so far in October, November, whether we're talking concentration, comparing when we have a lot of metrics here, comparing the S&P 500 cap weight to the equal weight, looking at market breadth, like on the bottom, the Mag 7 and their contribution to the S&P 500's return, in the first half of the year, essentially that they were the majority of the S&P 500's return. That flipped in the third quarter, where really it was the other 493 stocks that were contributing to the return. But so far in November, the market breadth and the concentration market breadth has been low and market concentration has been high. I think one interesting way to look at this on page 24 with respect to sectors. If you would have said at the beginning of the year, market concentration, and I point to this in the orange bars looking at year to date, you would have said, all right, we're going to have a highly concentrated year. The market's going to be up 25+%. What sectors do you think would do well? I think most of us around this room would probably expect that would be, led by the Mag 7, led by the tech-enabled stocks. Information technology would be one of the best performing sectors, and communication services would be one of the best performing sectors. Well, looking at the left side of the page, we see that, but there's also a bit of a surprise there. The utility sector is actually, at least through October, the second best performing sector year to date. Again, quite a bit of a surprise given the context and what you might expect. That's been driven by, the utility sector has been driven by two things. One, with rates coming down and utilities being an interest rate sensitive sector, but also with the big boom in AI across industries, one that's cloud computing and all the data centers that are required to be on the back end of this AI growth. Utilities and the demand for electricity has been they've seen their demand increase, and that's been one of the reasons why the utility sectors has done well. Additionally, just like almost any sector, with AI, with all this technology, you can optimize your operations. think of something as, building blocks and basic of a utility company, and how they can optimize and use the software to, whether it be on the power generation side or how they're, optimizing the grid, if you will. And so, it's been a good year for utilities, also for financials as well. Financials a little bit more driven by rates, and financials has also been the best sector month to date here in November. In large part, that's been driven by the election, post-election, with the Trump administration, as well as the Republicans coming in. The expectation there being that regulations for banks and for will be a little bit easier. Banks will be able to hold less capital, allow them to continue with a lot more of their activities, and be less onerous overall. Additionally, as rates have come down, that's a little bit of a tailwind for banks and their business model with net interest income. I'll try to wrap up the remarks here, but maybe just a couple other points. We've talked about concentration, you're aware of it, but on page 25 it just shows how the top 5 and the next largest 5, essentially the top 10, are at an extreme. At least going back to our data at Twin, going back to the mid-70s, concentration is at an all-time high. And I think what's interesting, looking at page 26, is that not only are the largest 10 companies that we showed on the prior page at extreme and the highest that they've been in terms of market weight, but really that somewhat come at the consequence of kind of that next 40, that other group of large companies. And this is actually one that I talked about in our portfolio positioning. This is an area where the prime portfolio is underweight, and so we somewhat benefit from being underweight to those kind of, this is looking at the S&P 500, but benefited from being underweight those, next 40, if you will, that have underperformed and gone down as the weight in the top 5 has increased. So, just been an interesting divergent path where you have, the top 10 increasing, but actually those kind of next 40, those other large cap names have been, underperforming and decreasing in weight. The last comment I'll make, again, there's some, charts that you can peruse at your leisure, all, kind of slicing and dicing the concentration and the size dynamics in multiple ways. But if I go to page 34, just again, considering that the equity markets have been up so well, over 25% year to date, question is, well, is that kind of stretch, and why has that been happening, at least in the long run? And the answer is because earnings have done really well. What you're looking at here on page 34, the line in dark blue is the forward 12-month earnings per share for overall the S&P 500 based on sell-side consensus sell-side analyst estimates. And you can see that there's been very strong earnings growth throughout the past couple of years. And that's what's led to the market's rise, and the price of the S&P 500, which you see in kind of the lighter blue, which we know now, even in November, has eclipsed 6,000. Just even in the third quarter, 91% of S&P 500 companies have reported as of Monday of this week, and the year-over-year growth for the third quarter for the S&P 500 was 5.3%. That's been the 5th consecutive quarter of year-over-year earnings growth for the market, and I can say that even going forward, I think one of the other reasons that the market has done so well, particularly in the second half, is the expectation that earnings growth driving the market will continue in 2025. The S&P 500, the projected earnings growth for 2025 is 14.4%, and actually, right now the forward PE multiple for the S&P 500 is 22%. One interesting thing to note for the mid-cap area, the mid-cap stocks, but in this case, just referring to the S&P 400 mid-cap, which is another proxy for mid-cap stocks, they're projected to have earnings growth around that same number for the overall market of 14. For the mid-cap, it's actually 14.7%, but they currently trade at a 17 PE multiple, much lower than the overall 22 for the overall market. So perhaps from a valuation standpoint, mid-caps look to be positioned strongly as well. I know I went through a lot, probably overstayed our time allotment there, so I'll pause and see if there's any questions from the board.
I've got two.
Sure.
Which is, it's more, well, here we use some charts for the S&P 500, and of course we use the Russell 1000. So, your personal professional opinion, which index best represents the U.S. market, if you had to pick one? Just curious.
it's a bit of a loaded question, John. I mean, we generally like the Russell 1000 just because it's a little bit more broad, diversified, and does capture some mid-cap stocks. That being said, they're pretty much interchangeable. I mean, if you look at, 20, 30-year returns for each of them, the difference on an annualized basis, they do vary over time, but generally it's gonna be within 5, 10, 15 basis points. So they are pretty, analogous and really almost interchangeable. The S&P 500, it probably has more brand cachet and recognition. But if you were to ask us, and let's say you were just an investor and you were gonna allocate and, use one as your benchmark, we kind of like the Russell 1000 just because, again, it does capture a little bit more diversified on the margin and so it does capture a little bit more of, a broader set of the economy.
The other question you mentioned earlier in the presentation, that you guys are looking for market inefficiencies, you're trying to tilt the portfolio. So, I mean, what signals are you looking at? What metrics are you evaluating to try to figure out, okay, there's a distortion here? So, do those distortions typically, how much do they shift over time, or is there one predominant component that typically is the one that generates the most, I guess, decisions to alter? So I'm curious to hear that.
Yeah, so again, as a reminder of our process, the two parts of one being the bottoms-up quantitative model, which includes 10 individual factors across value, growth, and quality. So, from one standpoint, we use that model to help us inform, and essentially, I guess you could say, kind of a filter or screen for the stocks that we expect to be higher alpha producing than not. Like when we rebalance the portfolio, the first thing is that we're gonna be selling stocks that have had some alpha decay that have gone, become lower ranked in our model, maybe a 1 or 2. And we're simply gonna be trying to replace those with a higher alpha, a higher stock, a higher alpha producing stock, at least our expectation of that. And so, so first that's, based on our model, which, we've done, which we've been running for over 30 years and, I've done a lot of research in the past and continually research of, not only what individual factors like a, forecasted earnings to price, and we have them, on page 43, looking at earnings revisions, all the 10 individual factors. So all of those components are, I'd say first kind of areas where we're looking for efficiencies, looking for, these individual factors, but also ones that work together to help us determine, alpha or, stocks that will outperform. Kind of the proof statement for that is on the following page, on page 44. Again, this is showing, over 30 years that the model has done a good job of differentiating between the higher ranked stocks and the lower. Now again, that's all at the model, and generally we'd say that probably contributes about 2/3 of our relative performance over the years, and that remaining third being the fundamental tilt. And kind of what I was talking about is, that is more of an art than a science. Maybe the model is a little bit more of a science, although we do make fundamental decisions about the weightings of those, the weightings of the individual factors in the model. So, we're aware of that. We don't just, again, let the computer decide. But with respect to kind of the fundamental tilts, really what, a lot of the data and charts that we have from pages, call it like 23 to, 40 something, those are the types of charts and graphs and data that we look at internally as an investment committee and discuss, think something about like for value and growth or defensive dynamic, we're trying to understand, one from a, long-term perspective is trying to maybe dissect like some of these themes, whether it be momentum or reversal, but as well, what macro and fundamental market impacts will have on that. For example, like what I mentioned with defensive dynamic, that was a fundamental tilt that was a little bit more of kind of an art of saying that we understand that rates are going to be coming down, the Fed's going to be cutting, and who's that going to benefit? One, the expectation is mid caps and also dynamic stocks. So it's a little bit, I mean, there's multi-layers to it. Again, from the model is a little bit more of the systematic aspect of kind of, what types of things and where we think, factors that can be predictive over time. But then, that other area for inefficiencies is more of the fundamental tilt and trying to incorporate, being informed by a lot of science, but, as an investment committee, trying to make those decisions and understand, contextualizing and absorbing a lot of information and other data.
Go ahead. I just was curious what your outlook is, whether you're concerned about, potential for inflationary pressures going forward, and, also the impact of potential tariff action, things like that. I know it's early in the process, but, it looks to be something that's gonna be considered.
Yeah, it's a very fair question, and one, I don't think, we're concerned about it, but I don't know if we have the answer, because frankly, I don't think that the administration has the answers of exactly what's going to transpire. That being said, along the line of questioning, if there is very strong tariffs that are imposed that would be inflationary, and that is a concern for the economy. And one of the things that we saw, going back about a year ago, large cap companies, mid cap companies, when inflation was a lot higher about 12 months ago, you saw a lot of companies talking about it. We saw margins come down a little bit, and it was a bit of a concern, and I think it would be going forward. That being said, I think there is also some faith in the Fed that they've, to this point, have, we've avoided a recession and gotten to a soft landing. Now, not to say that the Fed can be the be-all, end-all, and if you have from a fiscal standpoint, all these pressures and the administration and increasing inflation, the Fed can only act so quick and also only do so much. So I would say it is a concern, but it's hard to really take any action on it, because it's just too early to know exactly what will be implemented, and then understanding all the knock-on effects of it.
I noticed the same thing on the outperformance of the utilities.
Mm-hmm.
And probably the demands of AI ain't gonna go down over time.
Oh, that's just a function of relativities, isn't it? They were just so bad the year before.
Yeah, that too, but he made the point that it's a function also of the demands for AI for the utility. And that makes sense, but that's a regulated industry,
Mm-hmm.
okay? When you see these recent returns on equity, isn't it likely that the regulators are gonna force reductions on rates?
Yes, generally, but also, because that, it's not like, that would be done across the board, across the country, being all local commissions that regulate the utilities, I don't know, one, the impact of that, I think it's a general conclusion, but I don't know if that will affect every single utility, because, the timing of each one and making those decisions, but, even so, if from a fundamental perspective, that's been a driver, but also, we do see that the utility being interest rate sensitive also trades a lot with the direction of rates, and that's, utilities have been one of the worst performing so far this month. But yes, that being said, I think that probably caps from the fundamentals, maybe a little bit of upside and downside, because of the being regulated in most cases. But also, even within the utility sector, there are some independent and water utilities. So there's also ones that aren't just purely affected by that.
You're staying, 50-50 book versus value. What's the biggest variance there?
Yeah, so it's more so than 50-50, it's just trying to be, keep our bets consistent relative to the market. So, on page 19. So, the Russell 1000 does their annual reconstitution and rebalance of value and growth once a year at the end of June. So here we are sitting in October. You can see that, for the Russell 1000, growth is at about 52.8%, and value obviously 47.2. Effectively, that's because of those style returns since July 1. So we essentially we're not trying ourselves to be 50-50. It's all relative to what the market is. So for instance, as was the case earlier this year when growth was closer to 60% and value was 40%. Our portfolio then had more exposure than the 51% we have currently in growth. It was closer to the 60, but it was still obviously underweight underweight growth on a relative basis.
So you're pretty much constantly buying and selling stocks depending on your perspective of where the value is.
Generally, well, not just you mean value as a concept or like value
Well,
growth.
your enhanced performance
Yeah.
is really your stock picking ability.
We think, we think it's, like I said, and what attribution has told us over, 20 years that, in which we think, maybe, conceptually would make sense that roughly 2/3 of it, of our value added is from stock selection, and the remaining third is from our tilts.
This is just a curiosity, do you ever use options to buy and sell in order to take advantage of volatility and maybe enhance income?
We do not, it's one, for the strategy, it's, and like for your investment guidelines, we're not allowed to. We've always been a long, well, actually, in the past, we've run long, short strategies, but we've never been, we've always only been, an equities investment firm. We've never done options, managing for institutions, just like for the city. We can't buy options, we're stipulated not to, and so, and that's across all of our, strategies, so, that's not something that we do. I mean, I certainly can understand though, maybe, let's say for, someone who's unrestricted, like an individual or a family office or something, or foundation, doing a strategy where you can, at different times, sell volatility or buy volatility, it certainly can, enhance return, but
But
not something that we do.
when you buy, you could put in a limit order, for example, right?
When we make our rebalance, when we're doing our rebalancing, we're, again, selling names that have had some alpha decay, we're, maybe either be trimming a name or, selling out of a name completely, and as part of a large rebalance program, while our traders, when we're working with our brokers, we try to get, better pricing, we're not, just throwing it out, we try to be, not that you can really add a ton of value on the trading side of it, but, we don't, usually it's, when we're doing our trading, it's either at market or we'll kind of do it throughout the day relative to the VWAP, but we're not, like maybe an individual investor might, okay, I wanna buy Apple only if it gets to 330. That's not really how we do it. When we're doing a rebalance for the portfolio, we're looking at it holistically, we're looking at what stocks we wanna buy or sell or trim, which ones we wanna add to or buy, and looking at it from that perspective, not from a, we would be buyers of Microsoft at, 520 or something.
Many of our managers, when they give their report, show in the report the specific securities that they're purchasing, some that they've sold, some that they've recently bought, that sort of thing. I don't see any of that in this. Is there a reason you don't show that?
Yeah, I mean, well, I think in a lot of cases, and correct me if I'm wrong, usually that's a lot of cases, fundamental managers who, have a, again, maybe use the example of Microsoft or like a consumer stock that there's management's working on a turnaround and we really like, what they're doing, and we've seen same-store sales growth. Because of our quantitative-based process, it's not something that, I mean, we certainly could and show what has, occurred over the past quarter, buys and sells, but, one, that's over the course of a quarter, or even, maybe, since our last update, the course of the year, that would include like 30, 40 stocks, and a lot of times you'll see, maybe we're adding 20 basis points here, selling 20 basis points there. We certainly, if interests, we'd be happy to include it, but because, one, even though it is a low turnover strategy, about 25% a year, still, when we rebalance the portfolio every month, we're, doing about maybe about 2-3%, but that can include anywhere from, 3 to 4 names on the buy or and sell side to 7 or 8 or 10. So sometimes it could just be a lot of names, and it's also small amounts. So generally, what we've tried to do is kind of show that what's maybe more relevant for us, if like fundamental tilts on page 20 and how that's shifted over time. But certainly, it's interesting. We'd be happy to provide it, but it's just because of our process, we just hadn't always.
I just think that people around this table like to see that.
Yeah, no, noted. No,
For no other reason, they're just curious what you bought.
Of course.
How many stocks are in the portfolio?
It is on page on page 19, it's 168 right now.
Yeah, we've seen 100, 200, and we're all on average roughly 30% turnover. That's gonna be a busy.
Yeah.
paper.
Second question, your compensation right now is, as I understand, correct me if I'm wrong, you haven't gotten any compensation so far in what you've been doing, is that correct?
That's correct, yeah.
When do you anticipate that to begin? I'm uncomfortable with, not paying people to do what they're supposed to do.
Well, we certainly, always, would prefer, to get, paid, when we, started working with the city, we were comfortable with the incentive fee. I will say that, other incentive fees that we've offered to clients since that time, we have not done something, so the fee structure, for your portfolio is a 0% base fee with a 35% incentive fee. That also includes a high watermark since inception, and partially because of the year of 2020 and how difficult that period was and our underperformance. Even though we've outperformed in, subsequent years, we still, if you look at the since inception number, we're still trailing, and that's why we have not gotten paid yet.
The question is, when do you anticipate getting paid?
We would hope that would be, if we continue our performance, this year, next year, it's difficult, because of the underperformance of that 1 year and based on the time that, how it compounds, I think we're trailing since inception 80 basis points, so, the hope would be maybe in 18 months, 2 years would be, when we'd be able to, even if we continue with what the strategy has historically done, adding, about 1% of value added annualized, maybe it would be in about 18 months, 2 years, and we certainly hope to get paid. We would like to, and like I said, for subsequent clients that we've offered incentive fee, we've moved away from doing a 0% base fee just because, we are a firm that we have, need to keep the lights on, need to, for all our resources, our research and things like that, and that, particularly for, for large accounts, we've kind of shifted to be it's still very low, but at least a, few basis points, base management fee just to, kind of cover some of our overhead. But, I appreciate the question.
Yes, I thought we were paying on after some of these returns.
No, I mean, it was a,
0.78 negative since inception.
yeah, and like I said, because there is the, the since inception, high watermark, that's why we have not. There is on the flip side, there is a 75 basis point annual cap that the performance fee could be, but, we obviously have not, to this point, have collected a fee yet.
Any more questions from the board? All right, very good. Thank you very much.
Thank you very much. Thank you for the time.
All right.
Appreciate the opportunity to provide the update and all the questions. Of course, our door is always open. If you have any questions, anything that comes up, between meetings, our door is always open and love to chat. So thank you again for the opportunity, and we appreciate the relationship.
Great, thank you very much.
I will do. Thank you.
All right. Next up on hit parade, Loomis Sales. All right.
Morning.
Good morning.
You guys like hard copies, I could pass these out.
Oh, yes, I'm Donald Shepherd, and Eli was, is right at the core is what you have stated here today, and its basis point is 3.4. I follow Eli was regularly, very closely. I've not been off once.
Please, if you will,
March
presentation, as you can see, we were pretty
is
active.
predicting your money will be
questions,
in.
so if it's okay with you, if something kind of pops up in your presentation, just kind of
Thank
stop
you.
in and ask the questions that you interrupt your flow.
Absolutely, I think that sounds perfect.
Great, all right, well, thank you.
Thank you. And it's great to see you all. My name's Levi Dwyer. Work on the relationship management team here at Loomis Sales. I'm your dedicated RM, so it's great to meet you guys in person. That's kind of, I took over from Matt Buxton, who you may recall, so that was a few months ago, but it's great to be here in person and meet you guys face to face. Join with me today, virtually, Jonathan Kimbrough. He's the investment director on the team, on the Core Discipline Alpha team, and he is remoting in via satellite from San Francisco. Good morning.
Good morning.
It's early, right?
Sure.
Well, we're used to it. We're, most of the team here is at work by 5 or 6 a.m. We keep East Coast market hours, so it's, we're used to the early mornings.
Okay. Perfect. So we
Because his handicap's more than the rest of ours.
Sweet, so we can just flip to slide 3, we can just kind of dive right into it. I was thinking in terms of agenda, I could kick it off with a brief firm overview, kind of what transpired for the last year, and then I'll let Jonathan take it away with the investment strategy stuff. So on slide 3, you see a high-level details of the firm. So as of 9/30, we have approximately $390 billion in AUM. You'll see that 286 of that is in fixed income, and the remaining about 100 is in equities. It is it's been a good year for Loomis. Year end 2023, we're closer to around 330 billion. So the current 388 is actually a high watermark for Loomis sales. So we've seen a lot of inflows year to date, and we continue to see institutional interest, which is all good news. Apart from the Discipline Alpha team, which I'll let Jonathan dive into more, in terms of where we've been seeing these new accounts, it's been a lot of fixed income, kind of our full discretion, relative return team, and of course the Discipline Alpha team. And a lot of that's been in core plus, long duration, and multi-sector fixed income. We've also seen success in our growth equity strategies. So it's been a nicely kind of diversified boon for Loomis sales, which is what we like to see. The inflows are from primarily the kind of corporate defined contribution space, a lot of sub-advisory, and a lot of Taft-Hartley, but a large portion of the success is from public pension plans such as yourself. We now have 40 billion in U.S. specific public pension plans, and about 3 billion of that is in Florida. So it's definitely a focus of Loomis and something we take pride in. I won't dive into all these, but just a couple of the substantial wins in the public fund space we enjoyed the last couple of years, which is 3 billion, or last year, there's a 3 billion account in Texas, 800 million in Virginia, and 700 million in San Diego. So the fixed income component of Loomis sales has been a great success. And then lastly, just in terms of management personnel, there's been no changes to note for the Discipline Alpha team. For the firm as a whole, there was no major changes since we last spoke, but we did have 2 retirements from the board. One was Elaine Stokes, a long-term PM on a separate investment team, and the full discretion team, and then John Russell, our former head of HR. They both retired, and in turn, Pramila Agrawal was appointed to the board. She's a portfolio manager on our customized solutions team, so she kind of works across all the investment teams. So it totally makes sense that she's a rock star. Both of those were planned long ahead with succession plans long in place. So it doesn't necessarily affect you. Just want to make you guys aware. That's about it on my end. Unless you have any questions on the firm, I think we can let Jonathan take it away.
Proceed. Thank you.
Well, good morning, everyone. Just wanted to take a moment and thank you again for the partnership. Obviously, Levi is your relationship manager. I'm the investment director for the investment team, which manages this portfolio. But Loomis Sales has a lot of resources to offer, whether that's our macro strategies department or our custom solutions. So don't hesitate to leverage the resources of the greater firm should you have a need for that going forward. Levi mentioned it's been a good environment for fixed income, and that's certainly been the case for the Discipline Alpha team as well. If you look at page 4, you can see total assets for our platform, and we're also at a high water mark. We're now managing 21 billion, primarily investment grade fixed income. Core is which is the strategy that you're invested in, is our largest product with over 14 billion in assets. And it's really well diversified across pension plans, both public and corporate, healthcare, some Taft-Hartley. We've really diversified our platform well over the past 14 years. We're seeing a broad level of interest in fixed income right now, and we're really seeing it from 3 different channel types. I'd say we're getting the most attention from public pensions like yourself. I think the low interest rate environment of the past few years forced a lot of public plans into more illiquid or private assets. And now that investment grade fixed income offers higher yield levels that can get you to much more of your target return, we've certainly seen a rotation out of equities and private assets more into fixed income. We've been the beneficiary of several wins this year, and when I look at our pipeline, it's predominantly public funds that have interest in the core Discipline Alpha strategy right now. We're also seeing a lot of interest from outside the US, both in Europe and Japan. US dollar investment grade corporates right now offer a yield advantage over Europe or Japanese corporates, even after hedging out the currency impact. So we're seeing more interest from those overseas buyers in our corporate product and our core product. Lastly, corporate pensions have also been interested in the strategy. Corporate pension plans in the US are at an all-time average funded status. The average corporate plan is more than 100% funded right now. Because of that, some of them have been shortening the duration of their liabilities, and they've been more interested in our intermediate credit or corporate discipline alpha strategy, as they kind of look to lower the duration of those plans. For us, total net flows for the discipline alpha platform have been 1.1 billion year to date, and we have a robust pipeline of new opportunities. I will remind you that we are a capacity constrained platform. We estimate that we can manage a total of 35 to 40 billion in our style. So we're at 21 now, we're only about halfway to capacity. We have plenty of room to accept additional capital, but we are mindful of the fact that we can't grow too large and still be able to produce the consistent level of returns that we've produced so far. Our investment
I
team
give
can
up.
be seen
Why?
on page 5.
I don't think you're.
We gotta do one question here.
I said I give up. Why? If you can
For
do good at
capacity?
40, if you can do good at 40 billion, why can't you do it just as good at 80?
Yeah, it's a function of being able to get good allocations in new issues and being nimble enough to take advantage of market opportunities. So for example, a few weeks ago, we got a call from a broker offering a $50 million block of inbound. For us, because we have a dedicated trading team, we can move very quickly and nimbly. We can very quickly evaluate that opportunity and pounce on it and buy that block of bonds at a good value for 50 million. If we're at 80 billion, that $50 million block of bonds really doesn't move the needle on performance. But when we're around 35 to 40 billion, those trade sizes are much more impactful to our alpha generation.
Okay.
It's also a function of new issue allocations as well. The larger we get, the smaller allocation we're gonna get on new issues. So those are the two limiting factors, I think, that have us wanting to keep our capacity
All right.
contained.
Thank you.
Sure. Our team can be seen on page 5. We have a stable senior team. Most of the portfolio managers have been here since the beginning of 2010, or at least for several years at this point. We don't have any planned retirements, and we don't have any plans for any additional hires at this time. We are looking to replace one trading assistant that left us in October to pursue another opportunity. But overall, the team is very stable, morale is high, and we really feel like we're having a good year and operating really at a high capacity, at a high efficiency. We do have a model of distributed decision making. And what I mean by that is those that are closest to the markets are empowered to make our buy and sell decisions as long as they stay within a risk budget. So even though Lynn and Seth are our co-heads, they're not reviewing each trade that goes in the portfolio. Instead, our traders and portfolio managers are constantly buying and making those decisions on a daily basis. We think that offers a better throughput of ideas in the portfolio. It helps to kind of mitigate personal bias and allows us to stay very nimble. We also leverage the deep research resources that Loomis Sales, and that's an area where we feel like we have a competitive edge. Performance of your portfolio can be seen on page 6. For the most recent quarter, the portfolio returned 5.19%, essentially matching performance for the benchmark net of fees. And on a year-to-date basis now, we've generated 34 basis points of gross excess return net of fees. And we have outperformed our benchmark over all trailing time periods since the inception of this partnership back in 2016. Just a quick reminder of our tenets of our strategy. This is a benchmark-driven strategy, and we seek to earn the majority of our excess return from security selection. There's really 2 key tenets to our investment philosophy. The first is that we've got an intense focus on relative value investing. Security selection is the primary driver of excess return. So each day, we're constantly evaluating our portfolio to make sure we own bonds with best relative value. We have a dedicated trading staff here in Orinda that allows us to be very nimble, react quickly to market opportunities. This is a strategy that earns many small contributions from active trading in a diversified portfolio. Each day we're looking at where should a bond trade relative to another bond based in a spread context. So for example, where should JP Morgan trade relative to Bank of America? A name like JP Morgan has more than 50 different bonds in the benchmark, and that can provide us with 50 different ways to find mispriced securities along the curve. Often, we find small mispricings along, say, the 5-year or 10-year part of the curve, and we're able to initiate a trade, monetize that position, and then quickly move on to another trade. We do that over and over, and these small trades add up over time to a very consistent excess return stream. Second key principle to our strategy is that risk management is fully integrated. We tightly manage the top-down risks in this strategy, and of course, the primary risk in investment-grade fixed income is interest rate risk. So we seek to mitigate this by running our portfolio duration neutral at all times. Even during the trading day, when we buy a corporate bond or a mortgage pool, we immediately cross that trade with a duration matched treasury so that there's no interest rate risk getting in the portfolio on an intraday basis. We think our edge is in credit selection, but because betting on the path of interest rates is inherently more difficult, we take that out of the equation, neutralize that risk, and really play to our strengths in underlying bond selection. We also only take modest sector risk in this strategy, and by that I mean our overweights to the credit sector or the mortgage sector tend to be small, typically about 1 to 2%. Those are much smaller than our peers, and that's by design. We have earned value through our sector overweights over time, but the idea is that they're sized smaller so that this strategy isn't earning its return from beta allocation or market timing, it's really earning it from a lot of small idiosyncratic trades. 90% of our excess return comes from security selection over time, and only about 10% from sector allocation. This pattern of returns, when we look at our ranks relative to our peers in the investment universe, we find that our returns rank in the 28th percentile since inception, so we're in the high second quartile. But I think more importantly, and perhaps more impressively, is we're doing that with an information ratio that is the first percentile and tracking error that is the first percentile. So this is a strategy that has a very efficient portfolio, tight tracking error to the benchmark, but it's still producing a high level of excess returns. Because of the way we tightly manage these risks, our portfolio characteristics are in line with the benchmark, and you can see these on page 9. Our overall duration, yield, quality relative to the benchmark, it's in line with the aggregate index. And if you look at the breakout here for maturity and coupon and quality, you can see that there aren't any sizable bets along the quality or maturity spectrum. This is really a benchmark-driven type portfolio. And so it feels like the benchmark, it acts like the benchmark because that's your chosen beta you have in the portfolio. But even within this tight risk framework, we still find a lot of opportunities to drive consistent alpha over time. So flipping back to page 8, we've got a page that shows you a little bit more detailed attribution of your portfolio performance over the third quarter and the year-to-date period. And I'll just focus on the year-to-date period here. So as a reminder, this strategy earns the majority of its return from selection, and you can see that is the case in the year-to-date period. 24 of the 42 basis points have come from selection, and about 16 from allocation. Primary driver of returns over this period have been our credit security selection combined with our credit overweight. We've been overweight to the credit sector by about 2% on average this year, and credit spreads have tightened about 15 to 20 basis points this year-to-date period. We've also, another contributor of the year-to-date period has been our overweight to mortgages. We've been overweight to both agency and non-agency mortgages, and spreads on the mortgage index have tightened, and we've been able to add value there as well. Lastly, I'd say our position in ABS has also been a contributor. ABS is an area where we continue to see good relative value over short corporates or treasuries, and we've really found some good value there, and that sector has performed well this year. On this page, we've listed some top contributors and detractors, but what I would just point out is that because we have such a highly diversified portfolio, the top contributor for the year-to-date, which is NLink, that accounts for 1 basis point of the 24. So I just want to kind of point out that of the 24 basis points of selection, that's equally spread over more than 100 different issuers over this time period. And so not any single position is driving outsized returns in this portfolio. Still though, I think we could walk through two names on this page that provide some interesting examples and just illustrate our investment process. The first name that I mentioned would be Intel. And I actually have a chart to kind of illustrate our positioning on this on page 14. Intel is a household name, I'm sure you've heard of it. They are a big provider of PCs, notebooks, and servers. And across the company, notebooks account for about 35% of revenue, desktops are 20%, but really the largest source of revenue for Intel has been their server business, which accounts for 45% of their revenue. We've noticed over the past several quarters that while Intel used to really have a strong market share and competitive positioning, they've been losing a bit of that edge. They were also losing some share in their PC business earlier this year from China as that overall economy had been slowing. So we were overweight in Intel in February of this year, but when Andrew Henwood, who's the credit portfolio manager, was talking about this name in credit research, it was clear that the fundamentals here were starting to slow down, and they became a little worried about them losing market share. So we sold our position in Intel in June of this year at a spread level of 128 when the index was at 83 on those concerns. It turned out to be a good move because during their third quarter earnings call, Intel showed softer earnings, but it was really their market outlook that kind of spooked markets. They mentioned that their gross margins were expected to be considerably lower. They suspended the dividend, and they announced that they were on a cost-cutting program, which would include layoffs of about 15,000 to 20,000 employees worldwide. You can then see that bond spreads moved about 50 to 60 basis points wider later that year on that news. And because we were underweight in Intel, we outperformed on that position. Once those bond spreads had gotten much wider, we did re-establish the position in Intel at much wider spread levels, and we now have a modest overweight in the name. We want to kind of watch and see how this restructuring plan works out, but overall, if Intel does execute on some cost cutting and they are able to kind of maintain their competitive edge right now in the server business, we could see further spread tightening in the name. I like this example because I think it's a good example of how we can drive excess returns with an underweight position rather than just an overweight position. And I think it also illustrates how our job's really never done. We can't just buy a name and set it and forget it. We have to continuously reassess relative value in these names and trade in and out of them over the course of the year. A name that's been a detractor in your portfolio has been Boeing. I don't have a slide for this, but I will kind of walk you through the story of Boeing and our positioning in that name this year. And just at the outset, even though this has been a detractor, it's only detracted by about 1.5 basis points. So again, these names are sized in a way that no single name is going to blow up the portfolio. Was there a question there?
We had a question on one chart, but we were able to figure it out ourselves. Thank you.
Well, I give you.
So Boeing was a large overweight position earlier this year, and of course you're probably aware the company started to have quality issues. Doors and wheels were flying off the planes, and they received heightened scrutiny from the FAA. And much of the underperformance came from our overweight earlier in the year, primarily in the first quarter. We didn't anticipate that there were systemic quality issues at Boeing. We were thinking that this was just going to be a one-off issue, but it did turn out that over the course of the year, they continued to have continual quality issues, really needed to look at their production on a holistic level. After the underperformance, we did reduce our position in the name and we went modestly underweight. And then Boeing then came to market with a large new issue in April at higher spreads, which made it more attractive, and we did reinitiate a position in Boeing, but the name's really kind of traded sideways since then, and so we haven't really been able to recoup the underperformance from that. In addition to these quality issues, they've also had a change in CEO, and lately they've been dealing with a strike from the machinists union. That strike slowed production and led to an incredible cash burn in Boeing. Year to date, they burned about $8 billion in free cash flow, and so we were worried that the longer that strike went on, the slower the production would be and the harder it would be for them to return to productivity. However, there were still some reasons for optimism. The new CEO is saying all the right things. He has announced some cost-cutting initiatives, including layoffs and some divestments of non-core businesses. His priority is really fixing the culture, fixing the relationship with the FAA, and repairing, this relationship with labor. The strike was just recently resolved in early November. And now we do believe there is some potential for upside in Boeing. If they can get back to production and restore their production to good levels, there really should be some potential for those spreads to tighten. I think from a macro perspective, the demand for planes is still there. There's really only two plane providers, it's Boeing and Airbus. And a lot of the purchasers of planes have said they want a diversified source. They don't just want to buy from Airbus, they really want to have options in terms of being able to buy planes. So we continue to have a modest overweight Boeing, but again, I like that example because it just illustrates how the job is really never done. We have to continually evaluate our positioning in these names over the course of the year. Why don't we turn to page 10, and I'll walk you through some of our other sector allocation positions. You can see on this page that we've had an overweight to the credit sector of about 1.5%. Credit allocation has been 29.7 versus 28.2 for the benchmark. Credit spreads performed well this year. Credit spreads have tightened about 15-20 basis points year to date period, but they're now at levels that are historically tight. The OAS of the credit index closed at 72 yesterday, and there's potential it could be headed to break that and go into the 60s. Credit is certainly looking rich at these levels, but it is possible that credit spreads could continue to go tighter in the near term. Fixed income yields are in their 80th percentile right now, while spreads are tight at about their 10th percentile. But because yields are still so high, there's a robust buyer base that includes overseas, insurance, and they continue to buy for yield and will continue to do so. We also think that as the Fed continues to cut rates on the short end of the curve, that should spur some demand longer out the curve. We know there's a lot of money that's in money market funds on the front end, and as the Fed cuts those front end rates, that should be reinvested longer out the curve going forward. We're also expecting very low credit issuance over the rest of the year, and that low supply should be supportive for credit spreads at least through the rest of this year. When I talk with the team, there is a possibility we could lighten up the credit sector at the end of this year. Heading into January and February, there's going to be a lot more uncertainty. But for now, we are maintaining this modest overweight as we think spreads could tighten through the end of the year. We also have an overweight to mortgages, which you can see has been about 2.5% in the portfolio. There's a few things that support our overweight to mortgages. Spreads are still relatively high on a historical basis, and so the relative value of mortgages relative to corporate bonds continues to be attractive. Mortgage fundamentals are still very favorable. Over 90% of the mortgage universe is still unable to refinance at lower levels. So the average mortgage rate right now is about 6.5%. Many people have already locked in lower rates than that, and so therefore the prepay on these mortgages should be fairly slow going forward, which should be supportive of the asset class. We also expect lower interest rate volatility in the months ahead, combined with a positive supply and demand picture for mortgages. And as the Fed continues to cut rates, we expect that asset managers and banks should be active buyers in the mortgage sector, which should continue to support the asset class. I have a leaf blower outside here. I'm not sure if you can hear that, but it makes it very difficult to hear on your side. So if there's any questions, just do me a favor and speak up. It's a little hard to hear right now. The last couple things I want to mention here are ABS is an area where we have an overweight in the portfolio. ABS is one of our largest overweights by market value. These are short duration securities that are mostly rated AAA, and we find a good relative value relative to short corporates or treasuries. The majority of our exposure there is in autos, credit cards, and cell phone payment receivables. These ABS bonds have excellent structures that provide credit enhancement and loss protection, and they do provide a modest yield advantage over other asset classes, so we really like that asset class now. I'll just spend a moment on CMBS. It's a small part of the index and a small part of our portfolio. We continue to be cautious there. We have an underweight CMBS. There's continued challenges, particularly in the office space sector, and we're really watching that on a property by property basis. You can't, at this point in the cycle, you can't say New York office is good. It's really a matter of, well, Hudson Yards may have some good properties, but a block or two away, there could be another New York office building that could be struggling. So we're really looking, closely on any deals that we do buy in the CMBS space to look at the underlying properties and get a good sense of what's going on there. Just being cognizant of time, I think I'll just turn to a few macro outlook statements now.
I do have a quick question about your PI metric, your proprietary duration number.
Yep.
Just looking at those numbers, they appear to be multiples of a typical duration number. Is that fair to say? I'm looking at mortgage back, and you might see a duration there of 30, but you've got your PI numbers in the hundreds.
Hundreds. So what I would say about pi is this metric's very similar to duration times spread.
Okay.
So instead of using market value, it's a unit of risk that takes into account the duration of the bond and its credit beta.
Okay.
So the way to think about pi is, so for example, our credit pi is at 28, credit pi is at 22 at the end of this quarter. That's a pretty small overweight to the credit sector. What that means is that if credit spreads were to widen 100 basis points, which is a very large move, we'd underperform by about 22 basis points, which is relatively minor. So why we like this metric is because I think market value doesn't really do a good job of addressing the interest rate risk and credit risk. We could own a 3-year bond or a 30-year bond, and rather than say we're 1% overweight, we'd rather use this unit of risk that accounts for the extra interest rate risk in that bond. Does that answer your question?
It does, thank you.
Could you define the senior floor plan?
Yeah, sure. So senior floor plan is, the way I think about this is, let's say you're at the Gainesville Toyota dealership. That dealership is buying a certain amount of cars direct from Toyota, and as soon as that car is, so this is securitized at the dealership level. So this is the dealership's ability to sell cars to the consumer, and as soon as they sell the car, they kind of buy another one to resupply their floor plan. That differs from the prime loan and subprime loan, which are the actual consumer's ability to make car payments, right? So the floor plan is at the dealer level, and then the next two, prime and subprime, are the individual consumer's ability to pay on those car loans once they bought the car from the dealership over 5 years and taken it off the lot.
How do you think about the effect of the enormous public debt, particularly on longer rates? The demand for debt and the turn goes off into the future indefinitely. Rates typically are affected by inflation expectations and that sort of thing. But does the debt now give a certain buoyancy to rates that you wouldn't expect otherwise?
It's a good question, and I think certainly I've seen a lot of discussion around that in the market. But there continues to be a voracious demand for fixed income that's buying treasuries at these levels despite the level of increased debt. So we had a 10-year auction on the day of the election that performed really well, meaning there were plenty of buyers still out there to buy that debt. We had a 30-year auction, I think, at the end of last week that also similarly performed really well. So while it is a concern that fiscal spending and the debt continues to grow, and the Treasury's gonna have to issue more bonds to finance that debt, we haven't seen really any slowdown in demand for it so far.
Did you say earlier, though, that the demand coming mostly disproportionately from foreign markets?
No, I think it's coming from a lot of different channels. So we're seeing it in the US and the non-US. We're seeing the insurance channel, which really buys for yield, continue to love fixed income at these levels. It's been probably the most robust buyer base of fixed income that I've seen in years. And we think that should continue. I actually think as the Fed cuts rates on the front end, you'll see even more demand out the curve on the 10-year and 30-year parts. You know, we've looked at some money market balances. We found there's a tremendous amount of money still in money markets, which was a great trade. I mean, if you can park your money in a money market and earn 5.5%, a lot of consumers did that. But as front-end rates drop, that should get invested out the curve, and so we continue to see a strong level of demand for fixed income. I want to be cognizant of your time, but I did just want to make a few macro points. So our macro team internally at Loomis, they essentially look at three scenarios. The first is what I would call late cycle growth scare, meaning that we would have an environment of slowing growth, deteriorating labor market and corporate earnings, lower prices and lower rates. We only give that about a 15% odds at this point, you know, pretty low odds. The second scenario is a softer landing environment, and this is given the highest odds at 60%. And in a soft landing environment, we have positive risk appetite, continued strength in corporate earnings, solid consumer health. The labor market and inflation does cool a bit, but it does so at a pace that's really benign to the overall economy. So this continues to be what we give the highest odds right now. However, the third scenario would be one of a higher landing, or what I might call a return of a growth environment. Our macro department has given this about 25% odds, and in this scenario, we'd see one where we have a reignition of growth, which would reignite corporate health and earnings and put upward pressure on rates and inflation. I'd say post the election, the odds of a higher landing or return to growth have probably increased now. It seems that the prospect of lower regulation, lower taxes, higher potential for M&A under a Trump administration have really kind of unleashed some animal spirits and could spur higher growth. I mean, we're looking at, even since mid-October, it seemed the market was positioning itself for a Trump presidency, and we began to see 10-year and 30-year U.S. Treasury yields go considerably higher. So 10-year U.S. Treasury yields went up about 35 basis points. There's going to be a lot of focus, I think, on the CPI in the coming months to see what the path of the Fed should be at this point. There's certainly, I have some concerns that inflation could reignite. I definitely think we could see an environment where the Fed has to pause for at least a couple of quarters to watch inflation at these levels. I think, I think a lot of people are wondering, how does a Trump presidency affect markets? And it is true that some of the policy is still uncertain at this point, but I would outline essentially four things. One is there's a prospect of higher deregulation. Trump has been on the tape saying that he wants less regulation. That could potentially benefit finance. So you have lower kind of capital requirements, lower consumer protections, which is good for some of the more consumer-focused banks. It's also good for the energy and utility industries, particularly LNG and kind of the liquid natural gas. Some of the independent companies we've talked to have kind of come out recently saying they're elated with the Trump presidency. They could see lower regulation. That lower regulation also increases the potential for M&A activity too, which can be both good and bad. We have to watch out for issuers that are going to take on more debt, add to their balance sheet in order to buy companies. But there's also an opportunity in looking at acquisition targets that could potentially be bought under a higher M&A environment. Lena Khan at the Federal Trade Commission has a reputation for being very activist and has fought a lot of M&A deals over the past few years. It's likely that she's gonna be on at the FTC, and that can pave the way for more M&A activity going forward. Immigration is another area where Trump has said he really wants to tamp down on illegal immigration, potentially closing the southern border. On the margin, that's inflationary. It lowers the supply of workers in the United States, which affects, certain industries like construction and manufacturing and service industries. Tariffs is another area that Trump has been vocal about. We know Trump is a negotiator. He tends to start big but end up compromising, and so the devil will really be in the details on tariffs, on specifically what industries that will be affecting. But one area we're watching in particular is automobiles. A couple of these auto manufacturers do a significant amount of their business production in Mexico, and if Trump were to impose restrictions on Mexico, that could be particularly disadvantageous for Stellantis and General Motors, who have a high level of production in Mexico. I think the last thing I would just mention is that we can probably expect higher fiscal spending going forward. This was really going to be the case under either administration, but I think under a Trump administration, you have the prospect of lower taxes. So in addition to the government continuing to spend, we also have the prospect of lower tax revenues to offset that, and therefore more debt going forward. So let me pause there. I've probably taken up too much time, but let me see what kind of questions I can answer from the board.
Any questions? No, I think we asked some of them as we went along, so, again, very solid presentation, thank you for your time.
Well, great, we really appreciate the partnership. Don't hesitate to reach out to Levi or myself if there's anything else we can provide.
Great, thank you very much.
Thank you.
Thank you, Jonathan. Thank you all very much.
All right.
What kind of coffee does he drink to be able to do that?
That's a good question. Well, it's the headquarters of Starbucks, so maybe.
Oh, is that what it is?
Mainline.
Holy, what's he like in the middle of the day?
It's true.
IV direct.
Well, thank you all very much.
All right, safe
Thank
travels.
you.
All right, Brendan, you're next.
All right, well, we have a smaller number of documents, but we have the bigger one, we got the quarter book, and this is also obviously the fiscal year end period. So just kind of really briefly, I'll start at some of the earlier pages, page 6. For this year, markets were obviously fantastic. Just want to highlight, so the S&P 500 at 36%, the Russell Mid Cap and Russell 2000 small cap stocks up 26 and change and 29 and change. So you saw outperformance on a large cap versus small and mid cap for the year. International did about 25%, and then obviously fixed income. You just heard from Loomis, double digits. So really all the main food groups, if you will, where we invest, numbers were obviously very nice. So we have a general backdrop that things are going to be very positive. Page 7 just sort of highlights the contrast between growth and value. And I'm just pointing it out this quarter. I'll just use the Russell 3000 as the example. Notice value for the quarter was up almost 10%, 9.5%, versus growth at 3.4%. But if you drop down to the bottom right-hand corner on the year, growth is significantly better at almost 42% versus 27%. So kind of what I'm really highlighting is within the year, you're kind of getting these flip-flops. One quarter value does incredibly well, but on balance or for the prior few quarters, growth was obviously doing significantly better. So just wanted to again draw a little attention to that. So let's go ahead and jump into the actual plan itself. Page 18, which is where everything is. Oh, sorry.
Well, so you're showing energy as a negative here, for 2000.
That's page 7.
Also, yeah, I'm on page 8. And, I only point that out because it was consistent with what we were getting here a little bit earlier, where last year the utilities and stuff was down.
Yeah, and these are.
I'm seeing that as when I look at that, I see opportunity.
But interesting, you do see the utility sector.
Yeah.
So, and notice the difference too, just to your point.
The energy sector.
Right, well, you've got the energy kind of in the middle part. It's the Russell 1000, the large cap energy stocks up on the upper part of the page, and then the small cap
But
stocks.
both of them were,
Negative.
yeah.
Yes.
I'm just saying, I view that as opportunity, and maybe I'm wrong. Go ahead, sorry.
Yeah, well, here's one of the questions, that you might have. Under a new administration,
Yeah.
there's some expectations that the price of commodities and oil and energy goes down significantly. So maybe their margins start to suffer a little bit. Now volumes maybe go
Oh,
up.
yeah, see, I
That's
view
the
it
interesting
that
thing.
way, I think they take away some of the limitations that have been placed on this sector. Even though the price is gonna go down, I agree with that, I think the profitability goes up. That just,
Especially if it's not export.
yeah.
CNG is confined there. That is a world market.
And if there's continued issues in Western Europe, with Russia and Ukraine, to the extent that you can start producing other, sources of energy that can be, help fill those gaps, if you will. The only problem is sort of the long lead time. It takes a while to build up the infrastructure to be able to supply Europe.
You see those little things they put on ships, how much natural gas is on those things?
It's hard to compete with pipeline.
Yeah, exactly, but they're doing it.
Right.
I'm sorry,
No.
please.
It's a valid point. So again, going back to page 18, kind of top line, so I'm gonna go sort of fifth or sixth column over the fiscal year and the 1 year number, which is one and the same. 25.56%, beating the policy of 2464 and placing in the 4th percentile. Now that is a gross number, the universe is at the gross level. Net number, that works out to be 25.10. I'm on page 18, but the 25.10 is actually a number from like way in the back of the book. But I'm just telling you what on this page is gross.
And that's next.
Before fees, the 25.1 is the after fee number. So that's not exactly how it works, but that 25.1 is essentially what the actuaries can use in valuation. Phenomenal result when you consider your assumed rate.
Yeah.
Is obviously significantly lower than that. So again, top line overall, obviously a tremendous year.
But not as good as Williams.
Not as good as Williams. But I wanna, if we move down just a couple of lines, we've got the US total equity composite. You'll notice our portfolio did 31.46 versus the benchmark of 35.2. So that relative underperformance, when you compare it to the weighting of our domestic large cap, domestic equity, means that just on a relative performance basis, we were behind by about 2.25% at the total fund level due to the domestic managers' underperformance. Similarly, if you go and look at international, we were 2.57% behind the index. So that on a weighted basis works out to be about a 70 basis point underperformance at the total fund level. So you combine those two, and essentially in our equity portfolio, underperformed the benchmark by about 3% on the year. But if you look up at the top, we outperformed at the total fund level by about 1%. So where did that come from? It was all asset allocation. We had more, even though we underperformed relative to the benchmark, you had more of the assets earning 31 and 22, and less of the assets that were earning 12 and -4.
Well, that goes back to the adage that asset allocation gets you 90% of your equity.
Yeah. But I just kind of wanted to highlight, because you don't often
It's
see those kind of
interesting,
disparities, but again, it just sort of speaks to the overall performance, and kind of where it came from. If we move over to page 19, we get into the individual managers. I won't belabor this, but obviously Twin, who you just heard from, was behind for the quarter and now for the 6 months, but generally speaking, over the last 3 years, have been performing much better. But you can see that 78 basis point deficit since inception, which goes back to that fee discussion we've been having. So until they get back in the green there, they're still.
So help them get back in the green now.
Yeah. Barrow Hanley, slightly behind for the quarter, but generally a very good year, although again, that is in the lower performing part of the market in terms of being value. Value underperformed growth for the year. Brown had a good quarter, up 4.3, but certainly we've been talking quite a bit about that deficit, and certainly over the last year, almost 10% behind. Although again, it was over 32% return, but certainly well behind the portfolio. Interestingly, Pzena also had a very difficult quarter, only up 5% or so versus the benchmark that was up over 10%, which now pulled their 1 year below. Just coming into this quarter on a trailing, 9-month and 12-month basis, they were ahead, but this underperformance within the quarter kind of pulled that down. But if you look at the 3-year, still outperforming by almost 600 basis points. So again, that goes back to what I was saying earlier, kind of in that growth versus value. We've seen this sort of flip-flopping. If a strategy did well in the early part of 24, it likely underperformed in this most recent quarter or at the end of the fiscal year. If it was struggling earlier in the year, it performed better at the end of the year. DGI, again, sort of falls into that same camp. Negative 1.6 versus a positive 6.5. So just within the quarter, they were 8% behind. But for the year, even despite that, they were still almost 6% ahead of the benchmark. So it just goes to show how well they were doing a few quarters ago to suffer that big a drop, if you will, in relative performance and still do well. Then we got international. Both managers did very nicely for the quarter. 10% from Silchester, 9.9 from Bailey Gifford. The Bailey Gifford number obviously is a much larger margin ahead of their benchmark. And then interestingly, now look at the last 12 months. They're actually outperforming by over 2.5%. But it didn't feel like that, for the last 6 or 9 months, did it? We're looking at that trailing performance, and they had obviously a very nice quarter, and that really pulled everything for the year back positive. And then one other just kind of minor thing to note, because we have less in Bailey Gifford versus Silchester, that is also a reason why we underperformed in the total international, because we had more of the portfolio earning 19 and less of the one earning 29. Now, over the last 3 years, that helped us, but just within this particular fiscal year, that was negative. And then the last
really, all of that lower asset allocation to Bailey Gifford came from their underperformance.
Yes.
They didn't take money from them, they just lost those assets due to negative returns.
Correct. And again, so when you stretch it out over 3 years, we've had more in Silchester earning 8.6 versus the Bailey Gifford, which is -6. So on balance, it has certainly paid off, but just if you're doing attribution just on the 12 months, that was another, a negative toward the total fund return, even though you outperformed. And then the last two pieces, again, you heard from Loomis just a minute ago, but they've done a very nice job just kind of hitting singles and doubles, outperforming 12% for the year, about 0.5% ahead of the benchmark. And probably not an asset class we, a year ago, were expecting double-digit returns. But that certainly is a nice contribution, although a small allocation. And then principal, just fractionally behind their benchmark, but for the year, ahead by about 2.8%, although that is negative performance. They've done a relatively nice job, considering they're in that real estate space. But we obviously continue to see some of those right nows, although that allocation is much smaller.
Every so often I remember that, when we were talking to them, remember, it was so gung-ho and all, I kept thinking, this isn't gonna work. Well, it didn't work.
Well, I mean, when the markets are good, it works, but, it's been bad time for real estate.
But it is what it is. I mean, it's the point she was trying to convince me it is what it was, but it wasn't,
Yeah. And the big question there, now that we're getting some Fed cuts, how long does that take to really
How
start
much
to
office space
stabilize?
is gonna be,
That's
out
a
there
major
empty?
challenge.
I mean, it's real.
So there are two other things that I wanted to draw your attention to. I tend to skip over these, but let's jump all the way back to page 75.
Holy.
It's easier if you start at the end and go backwards. So I just wanted to highlight, again, I tend to skip over this, but this chart shows or tracks your asset levels over time, which is the blue line, your market value. So 729.4 million, not quite back to the highs we hit in 2021, but close. And then what I like to also illustrate along the bottom, that gray line represents your net cash flow. And so what you'll notice, if you go all the way back to say 2003 through up until 2020, essentially that, you know, $175 or so million of net cash flow was spent out of the plan. Or in other words, you had benefit payments that exceeded your contributions cumulatively of about $175 million over that, you know, 17-year period. Then we had the POV in 2020, which is that big step up that all of a sudden you see. And then interestingly, you on a net basis have almost spent all of that back out of the portfolio in the subsequent 4 years. All the while though, again, even though you've got that negative cash flow, meaning paying out more than you're bringing in, still on balance have an increase in the overall market value. And that again, you know, very simple terms, that's the sweet spot of pension investing. Even though you have outflows of cash, you're able to grow assets at a faster rate than you're paying out those payments. And then just to kind of put the last thing I wanted to draw your attention to, again, I know I tend to skip over these, but on page number 79, we talked about the returns, that 25.1% net fee, or excuse me, net return. I just want to focus on the very top line here. We started the fiscal year 10/1/2023 with 597 million in assets. Over the course of the year, we had outflows, net benefit payments of 19.2 million. You had income from your investments of 6.6, appreciation of $144 million. Add all those numbers together, and you come up with the 729.4, which is where we finished the year.
So the income is dividends and interest?
Correct.
And the net outflows, does that include manager fees?
I believe it would, yeah. Yep. So we always talk about the returns, but I just wanted to focus on the dollars.
For you to take back to your masters, you know, the job being done well.
Yeah, we didn't quite have numbers in time for, we have to go through the finance committee, subcommittee of the commission, with our performance numbers and our
That's
annual
frightening.
reports. That was originally scheduled for Tuesday, and we didn't quite, we just had the numbers for the pension plans last week, but that wasn't in time to get an agenda on that meeting, so.
Although I'm sitting here thinking you tell them that they're gonna wanna spend the
Yeah.
money.
I'm
Be
sorry?
careful. Yeah.
Yeah. Well, you know, we don't try to, we don't make a huge deal of it when we have a good year, and we don't make a huge
Good
deal of it
point.
when we have a bad year. We
Reference
we
to-
show them, we like to show them the 30-year annualized number.
Good
And,
point.
Yeah.
Something near break even, huh?
Yeah.
Speaking of, what's our funding level?
I'm sorry?
Funding level.
As of the 2023 val, we were in the mid-90s, I think. And it'll be, I think we'll probably be fully funded as of the 2024 val, but we won't get that probably until June of next year.
We were gonna be there, but it just.
Yeah.
Well, but you also smooth the results.
Yeah.
So
Yeah,
you,
5-year smoothing.
You don't take $144 million and just load it all in at once. You're only taking 20% of that this year and smoothing it out over the next, 4 years.
It's a great staff for you.
Yeah.
If there aren't any other questions to the report, again, I won't spend time on it, but you've got the most recent update through the end of October. You've seen this chart many times. I just wanted to, update you on that.
So not kick horse, what's the funeral plan? That was my question too.
It is sort of the same kind of issue where, relatively defensive within that growth space and also relatively concentrated managers. There's a number of them that are very similar, and all of their performance is within a relatively small bandwidth, kind of the same. You're seeing a lot of very similar levels of underperformance. A lot of that has to do with just not owning the Mag 7. Or if they own some of the Mag 7, they certainly don't have 60% of the portfolio in the Mag 7. So then the question becomes, what does the next 5 years look like? Does this continue to be a Mag 7 dominated market where, when we're having this conversation, instead of 60%, I'm referencing 60%, the top 10 stocks within the Russell 1000 growth now represent 60% of the index. 10 years ago, it was 23%. So if 10 years from now, the top 10 are 85% of the index, you're going to have sort of a similar type discussion of the vast majority of managers are underperforming, active managers are
Should we
underperforming.
be questioning the managers, or should we be questioning the index? Let's talk about
I think, correct me if I'm wrong, I believe I've even mentioned that here in the past, that I've not really heard spoken about much, sort of broadly, but I've been having this conversation for the last year or so, and asking the question of a few of my researchers and things like that, where.
So you can say on one hand, the brown is over here, and they're all these red numbers, they're negative, and they're not meeting the red, this right. Then I look at, since inception,
14%.
they've returned 14 points. Wait a minute, who's got better than that? Nobody. So, I have a hard time.
Basis points behind, we're still.
What's the index mean? Doesn't mean anything to me, because they contributed more to that great number that makes him look good than anybody.
And I think one of the other components, we talked about this in the past.
I wanna get upset, I'm with real estate.
Right.
Then you're back to my key point.
Even though that's green.
Yeah, that's right, I didn't see it there.
It's
They're not carrying their weight.
Relative outperformance, but in a negative asset class.
Comment. I'm sorry.
No, it's been.
But I
an
question the
ongoing
index
discussion.
stuff here some once in a while.
To me, if you wanna be more tactical about it and maybe look out over the next 4 years, what does the new administration's policy, how does that impact the Mag 7? Are they gonna benefit from that? Does it make sense to maybe allocate a certain amount, to an index, whether it be Vanguard, S&P 500 or something like that? I'm not saying we should, but I think that's
Good question.
that's the discussion, are the Mag 7 less likely to be, to see some sort of reduction in earnings or, reduction in valuation or correction over the next
Or the
4
opposite.
years, or the opposite, right?
One that I've heard people talked about is Meta.
It's more a function of tariffs than what's it gonna mean. You can read both sides of that, depends on who you read.
Well, it's hard until you get a clearer picture, like Lingus was saying, of how things fall out. I mean, it's one thing to make statements during a campaign, it's another thing to implement them.
But do you doubt that technology is going to dominate in the next 10 years? May not be those metrics in 7.
Yeah, I definitely think, you will continue to see innovation and higher growth out of tech.
Where's the catalyst to change? What's out there that's gonna knock off Facebook, Nvidia, what?
It seems to
Where's
require.
that?
I think there's a
competition.
the one you just named, Facebook, Meta, there's a political argument for why it could take that one. But the rest, Nvidia or the others.
Who's the next one? Who's the next Netflix that's gonna kill Blockbuster?
Yeah, because there will be.
One of the.
Because there will be,
Yeah.
yeah.
One of the
What's
things that I
interesting
mentioned-
is that they're moving towards dividends. Sort of a sign of a maturing
Right.
company.
There's not enough companies out there for them to buy, so they give it back.
There's another component too, we talked again about 60% being in the top 10. The historic average is in the mid-20s. The top 10 represents roughly 25% of the index. If you're an executive at Russell and your job is to have this representative index, how long can you sit there with a 400 stock index that's 60, 65, 70% in 10 stocks? What happens if June 30th, they decide to push a button, they say, we can't do this anymore, we have to change the methodology of how we constitute the index, and in one day, Microsoft goes from a 13% weight to a 7% weight. If you're in the index and you're owning 13%, that's a really tough day.
Well,
And again, I don't know how likely that is, but that is a risk, in my mind, that is a big risk associated with the indexing, is because it is so
To
concentrated.
that end, are there, I mean, I'm sure there are, but, you know, large cap growth managers who are less defensive and would own more than that, you know,
Certainly.
and, but still be able to adjust if they saw something happening with, say, Meta or something like that, and, you know, address that, so that you're not sitting in an index where you don't have any control over it. You're allowing a manager to exercise that control.
Vanguard's 10-year under 13.65. Brown's is 13.7.
The Vanguard, what, S&P, or S&P, yeah. Like, growth has done better than the S&P over the last 10+ years. And there's another manager that I have multiple exposures with, you know, Whole. Right. Very similar profile to Brown, from the concentration and the types of things that they look for. And their entire philosophy is that we wanna have a basket of 20 stocks that grow earnings between 14 and 15%. That's what we care about, and we think over time, that's what the returns will be in the portfolio. Because, you know, in between, markets are gonna do what they do, but if you can grow earnings at 14 to 15%, 20 years from now, we're gonna have a return of, and just like Brown, you look at their 10 or their 15-year number, and it's like 14.2%. And so I kind of go back to, if we were sitting here in 2011, when you were hiring Brown, they said, hey, we're trying to grow, we're trying to have a basket of companies that are gonna grow earnings like this, and that's what we think the return should be over time. And they told you the number was 14. I would bet we'd all say, yes, I will take that every single day.
Sure.
We're only having the discussion because instead of 14 be indexed, it's 17 plus.
I mean, if we earn 14 on the entire portfolio, we would, we'd be the best performing pension in the country.
So it's an interesting kind of dynamic, that plays in. When you have to factor in the risk side of it.
As long as the past remains prologue.
The ultimate goal seems to be is we're trying to drive returns at or in excess of our assumed rate of return for the plan in order to pay long-term benefits where we don't have to charge more taxes to people to cover a pension plan. And so long as, I mean, ultimately, that's the big goal. And we've done that exceptionally well for over 30 years. I think the current composition, given all the uncertainties, I think we're in a very, very good position. And the proof has been in the pudding. And so, yeah, you get the relative, you know, is my car as nice as the guy next door? I don't know. My car tends to get from point A to point B comfortably and safely. I think I'm good. And I think our portfolio, frankly, has done an exceptional job. So I understand you always want to look the internal, right? If something is dramatically underperforming based on what we have, great. But boy, the unusually high allocation to managers are kind of value bias that we've had, and having active managers has served the plan exceptionally well for a long, long time.
120 basis points.
I haven't run the math, but that is a lot of millions. If you annualize that difference over 30 years,
Yeah.
if I had to guess, I'd say that's probably about $200 million difference.
So I have a question. This is, I don't know, any other, I mean, given our fantastic performance, and obviously we've been well allocated equity for a long time, it's served us long run really well. I'm curious, and I'm wondering if there's an interest from an educational standpoint next year, just like you did for the real estate, which I thought was an exceptional presentation. I would love to hear you guys take an evaluation of private debt. And there, I mean, and I'd really be interested to have an objective assessment. And I know that it's something that intuitively intrigues me professionally in terms of maybe considering using that in the portfolio to maybe de-risk to a degree. But again, I also know there's a lot of pretenders in that industry, and there's some good ones. But I'd love to. I don't know. I think from an educational standpoint, I don't think we have any major manager searches. I would welcome that education. I don't know if the
And
rest
the
of the
same
board is
thing for
interested.
private equity.
Yeah. It-
I went to all of those conferences,
Yeah.
down at the FPPP. Honest to God, I was still very, I felt like I was getting timeshare presentations. It was just.
But even as fiduciaries, if we review it and we say, look, we don't wanna do this for all these reasons, I think, we're supposed to be, kind of on the vanguard, looking at options, and many times, a great decision is to do nothing. But I think if someone would ask us, if you guys evaluated this,
Yeah, we ought to be able to.
I think we should be able to, so that'd be my.
We've done that before, we've looked at private equity and private credit in the past, and we didn't take any action, but, it's fine to look at it every 10 years or so,
And I think the presentation you did on the private real estate was terrific.
And if you'd like us, we'd be happy to do something similar with the private assets. You just.
Okay.
Tell us.
Dave, you did give me the blessing, so this is.
There
a-
you
So, I mean, really, just, when would you wanna hear?
Right now, we don't have another meeting scheduled.
I was gonna say, well, that leads to this.
Until February, I believe,
We're not gonna have a December meeting this year.
not unless you really want one.
What wouldn't be we don't have one in January, so it looks like February would be the next logical.
Yeah, DGI.
And I did just.
I'll be in town, it's Martha's birthday.
I did spoke to, Rick Hansen from the DGI, portfolio manager, cause I was asking about super micro. Nick Hansen, I'm sorry, Nick, thank you. And we had a discussion Monday, and he basically said, obviously super micro's gotten blasted, that was one of their top holdings. He said that, he sent me a document, I've not had a chance to read it, but basically right now, it's only 0.7% of their holdings. In part because it's dropped, but they also made a significant sales and de-risk over the course of this year. So at one point, it was their top performer and their top holding. Evidently, their risk process of resizing took it down. They did not know that it was gonna have some challenges. And he said initially they weren't as concerned with some of the reporting issues. They said they haven't gotten some of the answers that they would expect. And so they said they're much more concerned than they were 2 months ago about super micro and reporting. So, anyways, I just want to give a quick update because that drove a lot of their return.
It did, both on the way up.
Yep.
And then, 18 months ago, 12 months ago, it was a huge contributor on the way up. Greg pulled up the chart of it during yesterday's meeting, over the last 12 months, and it's a big up and down. So, just one point of clarification, it mentioned private equity, but obviously the focus of what you were talking about was private credit. Do we want to try to do both, or we can separate?
I think we should separate them, I think, personally.
But
We probably don't wanna do both at the same meeting.
Right.
Agreed.
Do private credit first, and then decide.
I think so.
When it makes sense, so we do
Yeah,
it.
I think so.
And quite frankly, it's a separate team within our.
Perfect, yeah, I think that'd be great. So you want to just set,
February?
I think February would be great.
Okay.
Cool. All right, any other questions? Dates? Well, we do have the dates for next year's, reviews that have been
Just out of
presented.
curiosity, why is the November date earlier in the month than the rest of them?
Because of Thanksgiving.
Because of Thanksgiving?
Same with this.
Sort of the way we did this one?
Correct.
Okay.
Okay, cool.
I'm gonna miss two.
Yes.
I'm gonna miss June and November. Cause I'm gonna go to a police fire conference on that day.
Okay. Obviously, we have to get ready.
Pardon?
No, wrong.
That's fine, and again, who knows, but no, I think, let's go ahead, do you want an approval?
Sure.
All right.
Move the approval.
Move approved, do I have a second? Second, all right, meeting dates for 2025 have been approved and will be enshrined, thank you. Any other comments from anyone?
Public comment?
Public comment, anyone?
My public comment was about, I haven't heard anything about LSD. Where is the input about LSD?
We don't have LSD as a manager.
We don't have it on.
No.
Okay. I didn't know that, so I'm
Okay,
inquiring.
okay, that's fine.
That's the police and fire plan.
Correct.
All right?
John, it was,
That's why
that book,
I didn't hear it.
Yes.
Yeah.
it's on
Police and fire
Pennsylvania
was yesterday.
Road website.
their police and fire department should do this in general.
So I'll go ahead, close the meeting. All right, very good. Thank you, everybody.
Happy holidays, everybody.
Yes, happy holidays.